Welcome back. Over the past couple of months, we've deep dived into the world of mutual funds, understanding what they are, how to go about building a portfolio, do's and don'ts, and a lot more. Now we turn our focus to direct equities. And for that, Rajiv Lula caught up with a financial expert.
Thank you, Pranav. For the last 7 weeks, we were talking about mutual funds. And today, if you're ready to take a little bit more risk for some more rewards, let's shift gears. Let's meet our guest for today, Mr. Prasad Nalam. Welcome to the studios, Mr. Prasad.
Thank you.
He's the CEO of India Macro Tools, and today we're going to be talking about direct investments. Let's open it up. Tell me, what is direct investment?
Yeah, direct investment means the retail investors investing directly into the stock market. Mutual fund is one vehicle where you take the expertise of an expert fund manager to invest for you in the market, whereas in direct equity you dabble or you directly deal with the stocks. Are you a huge risk taker? What is your nature and how do you behave yourself when a risk manifests in front of you? You have to understand all of it.
Now, Mr. Prasad, we're talking about money which can be counted, measured, gains that can be counted.
Yes.
Now, all that can be quantified, but the criteria that we just laid out, right? I mean, how much risk can you take? What kind of personality do you have?
Yeah.
It's hard to kind of quantify that.
No.
For our viewers out there, for their benefit, let's try to kind of, tell them who they are.
Okay.
What would the criteria be?
Yeah. I mean, risk is easy to be measured actually. It's not as complex as what people think. For example, if you are playing cards in your family with your aunts and sisters, you would say that after losing 1,000 rupees or 5,000 rupees, depending upon what you lose, you say that I am calling quits. It means your risk-taking ability is limited to 5,000 rupees per day. But if you are going to say that I have to beat my aunt and sister and I am going to stake everything like what Yudhishthira did in Mahabharata, you are a compulsive speculator. In the first instance, you have already predetermined that $1,000 is what I am putting on the table and I am willing to lose that. So first thing is to assess this amount of how much you want to put it at stake for something that is of extra high returns.
Yes, I mean, I know that the markets recently crashed. I mean, the outlooks changed a little bit from what it was for the last 7 years. Yeah. What kind of metrics am I looking at to measure my own success?
Yes. You see, the important thing is like what I said, if you understand yourself, you also have to understand that the returns from any kind of asset class, whether it is equity or real estate or gold or anything, in the long run, they all tend to give you the normative returns only. Equities in the near term can go up by 50%, fall down by 50%. But if you take the long history of Indian stock market from 1990, the simple returns from the market had been around 18%. That is, if you are holding from 1990 till date, you had an 18% per annum return from the market. Now, you have to always keep your expectations very low and always try to see what is the alternate investment avenue for me to make money. Right, yeah. For example, today if you are investing in a bank, the bank gives you 7% interest. You have to say that if I can get 11% from the stock market, I am happy for the risk that I am taking. If that is the approach, your ability to invest in the market will be far more easier. But if you are expecting the moon next morning, you are into trouble.
Right. Now, Mr. Prasad, returns are also a function of diversification. So how large is your portfolio? How did you choose those stocks? If I understand it correctly, the more diverse you are, the lower your risks.
Actually, diversification necessarily does not mean that low risk and low returns also. Now, for example, if you have diversified and had 100 stocks and all of them small cap stocks, with 100 crore or 200 crore market cap and you do not know what those companies are doing, even if you had 100 stocks, you will not make money. But if you have chosen only one good company, which is a large company and which everyone knows, you might still make more money.
Now, without taking any names, or maybe we could take a whole lot of names, how do you choose that one company?
Yeah, very good question. See, if I am an employee, I mean, I am talking about two typical people. One is a businessman and one is an employee. If I am an employee and incidentally I happen to be working in a listed company, I better invest in the company in which I am working because I know that company much better than any outsider, right? If I am not working for a listed company, but I know that company, which sector I am, and if I believe that the sector is growing, I put the money in the company in the listed space from the same sector. And the third option is, if I am planning to move my career from one company to A company to B company in the same sector, that means I am thinking that B company is much better than the company I am working for. Buy the shares of the B company, because you have already made up your career decision to move to the company B, and that's where you think growth is, and you typically invest for growth. So buy the B company shares. Okay.
Now that is interesting. I think it's a very good way of investing for some people. But the counter argument for that would be Enron, Satyam. You know, any kind of company that's flawed.
Yeah.
And what we found in those cases is a whole lot of people that put all their eggs in one basket. Their job, their investments, everything's kind of tethered to one. When the ship sinks, it all goes under together.
The important thing is, just because you are working, you do not put. You have to understand the buzz around you. Is your company growing? Have you had an improvement over the last year relative to the current year? These are all the things you have to answer. But remember, Enron and Satyam are one case in about 970 companies that are listed on NSE. Satyam is only one case. There are another 969 companies which have been doing well or where nothing has happened. These kind of one-off instances do take place. But investment always has to be with full knowledge.
Tell us about the tools that are available.
Yes. See, 2-3 things you have to definitely measure. One is the dividends, how much dividends the company is giving. Now, this is very important. There are two ways of looking at it. Dividends means not in the sense of the 2 rupee, 3 rupee that you get from the company. How much of the profits of that company he is giving back to you as dividends? Say 30% of the profits, 40%, 50%, 100%. Now, if you are a conservative investor, buy a company that gives out 90% of its profits as dividends to you. That means that the company is not seeing great growth perhaps in its business, or whatever assets it has got, it has the capability to sweat it more for you, but you get very good dividend flows.
Mr. Prasad, dividends, I'm sure, is just one of the tools, and there's a lot to talk about. Well, we'll follow up on this conversation again. Thank you for joining us this week. Pranav, back to you.
Thank you, Rajiv. Stay tuned for a chat with Dr. N. Ravichandran, CEO, Lucas TVS.